So, you want to grow small sums of money and 10x them into big returns. As crazy as it sounds, what if I told you having less money than Warren Buffett actually gives you a much more significant advantage? Warren and Charlie have frequently said that Berkshire's large size has made it significantly harder for them to keep on growing the company at the same rates as they used to. This is because, as Berkshire Hathaway has continued to grow in both size and market cap to a staggering $793 billion at the time of this recording, it takes a much bigger investment to move the needle. So, with all that said, you're still wondering, how does this give you the advantage? How about I explain that to you using the following example given to us by Warren Buffett?
My question is, you've repeatedly said that you see many wonderful stock ideas, but can't invest because they're too small. Given that many in the audience today have a lower dollar investment threshold...
Do these stocks have names?
Yeah. Well said.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than 100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. And I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, I've got this wonderful thing, and I usually know ahead of time, but I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further, because there's just no time to be looking at all kinds of smaller opportunities. I do think if you're working with very small amounts of money that there almost always are some significant inefficiency someplace to find things that I've mentioned to some people. When I started out, I actually went through all of the Moody's manuals and the Standard & Poor's manuals page by page, and it's probably 20,000 pages, but there were a lot of things that popped out, and none of them were in any brokerage report or anything of the sort. They were just plain overlooked, and you could find out about them, but nobody was going to tell you about them. And my guess is that continues to be true, but not on anything like the scale it was then. Charlie?
Well, I can remember when you bought one membership in some duck club that had oil under it when you were young.
Yeah, there was a company called Atlas.
When you get down to one duck club membership, well, you're really scavenging for cigar butts. But
not a bad cigar butt. There were 98 shares outstanding. It was the Delta Duck Club, and the Delta Duck Club was founded by 100 guys who put in $50 each, except two fellows didn't pay. So there were only 98 shares outstanding. They bought a piece of land down in Louisiana, and one time somebody shot downward instead of upward, and oil and gas started spewing forth out of the ground. So they renamed it Atlas, which is Delta spelled backwards, which was sort of illustrated the sophistication of this group. And a few years later, they were taking, at $3 a barrel oil, they were taking about $1 million a year in royalties out of the place, and the stock was selling at $29,000 a share, and it was earning $10,000 a share. No, it was earning about $7,000 a share after tax, about $11,000 pre-tax, and it had about $20,000 a share in cash, and it was a long-lived field. So, I use that sometimes as an example of efficient markets, because somebody called me and offered me a share of it, and those things, is that an efficient market or not? $29,000 for $20,000 of cash plus $11,000 of royalty income at 25-cent gas and $3 oil. I don't think so. You can find things out there. I'll give you hunting rights on all my duck clubs in the future.
So, the first advantage this gives you is that you don't need to make a large investment to move the needle, as Buffett says. As stated before, Berkshire's current market cap is $793 billion, And let's say to move the needle, an investment needs to be worth 10% of the company size, which means for Berkshire that the business needs to be worth around $79.3 billion. So, to put that into perspective, let's see what kind of businesses Berkshire can get at that price. Monster Beverages is currently valued at $58 billion. Restaurant chain Chipotle Mexican Grill is valued at $53 billion. FedEx, the packaging and delivery company, is valued at $63 billion. And hotel chain Marriott is at $60 billion. As you can see, all these companies are absolutely massive, and it would take what Buffett calls an elephant-sized acquisition for it to have a meaningful impact on Berkshire Hathaway. So, because of this, it limits the pool of potential investments Berkshire Hathaway can make, which is making Buffett's investable universe smaller and smaller as Berkshire Hathaway grows in size. Now, let's compare this to a man with a much smaller net worth, and he needs an investment that makes up 10% of his portfolio. Due to the smaller sum of money, his investing pool is so much deeper because he can invest in very small companies or in mega cap stocks. Let's use the Delta Duck Club example that Warren gave us. It was a former hunting ground until it was discovered that it had valuable oil underneath. There were 98 shares in existence, each trading at $9,000 a share, while it produced $11,000 in after-tax income, which makes an obvious good investment. However, this is only a great investment if you have a small sum of money. If Berkshire was to make the same investment today in Delta Duck Club, that investment would represent 0.0001111% of the market cap of Berkshire Hathaway, which would make it not even worth Buffett's time because it represents such a small part of the company size and it would be essentially meaningless. But let's say someone who has an investment portfolio of $30,000. The same investment would take up a much larger chunk of this person's money. Let's say if he bought 3 shares of this company, valued at $27,000, and the stock price doubles from here. He will literally almost double his entire net worth, which has a far more meaningful effect on his portfolio compared to that of Berkshire's. So, this then brings us to the second advantage of investing small sums of money, which is you have less competition. In the world of investing, as the size of a company increases, there are more and more investors and investment analysts closely following that stock, which means you are competing against more people. Take Apple, for example. It is the largest company in the world by market cap, valued at $2.76 trillion. Due to its enormous size and the popularity, it is followed by thousands of very smart investors, and these people work at some of the most prominent hedge funds and investment banks all across the world and went to the top tier elite universities all around the world. So these people are very intelligent. So because of this, the odds of Apple becoming mispriced or undervalued is pretty low because the second it starts to dip, most of these investment funds begin to buy up the stock, pushing its price back up. However, it is still possible, but compare this to a much smaller stock that's valued at 100 million. This company will get far less attention from the Wall Street analysts because it's so small. The odds of it being mispriced are so much higher. That's why Warren said if he was to start out again, he would only focus on small companies because there are far greater opportunities in that realm. So if you want to grow your wealth and 10x your returns, the less competition, the better. The next advantage you have is being able to stick with smaller companies. This works to your advantage because large investment corporations like hedge funds and managed funds have requirements such as investing in companies with a minimum $5 billion in market cap. Otherwise, if it's any smaller, it's too small to impact their portfolio. Peter Lynch notoriously coined these growth companies 10-baggers because these sort of companies could increase in size by tenfold, and so would its stock price. This is because the smaller a company is, the easier it is for it to grow. Take, for example, it's easier for a company to grow revenue from $1 billion to $10 billion compared to a company trying to grow from 100 billion in sales up to $1 trillion in sales. So, in summary, if you want to 10x your returns and grow your small sum of money, remember, You don't need to make large investments in order to move the needle. You also have less competition, which means you need to stick with smaller companies. So that's all for today, guys. If you enjoyed the video, please like, subscribe, and share, and I'll catch you again in the next one.